Today's real estate investment topic is 1031 exchange, a tax-deferred approach to invest money from the sales from one investment property into a like-kind new property. I am Iris, a realtor and a real estate investor in the Pioneer Valley, Western Massachusetts. If you are new here, you're welcome to subscribe to my channel for the tips of living and investing in the Pioneer Valley. Well, what is a 1031 exchange then? The name comes from Section 1031 of the Internal Revenue Code. It applies to property held for productive use in trade or business or for investment. It's a powerful tool for investment property owners. If you follow the IRS rules, you can sell, then acquire new investment properties in U.S. tax-deferred. For example, you can sell your multifamily rental house in Massachusetts and buy a new motel in Colorado, or buy a farm if you desire. This tax deferral method doesn't apply to foreign property or our personal residence. It doesn't apply a quick flip of a house either. Let's look at some numbers. If you don't use a 1031 exchange and you sell an investment property, you see the list of your tax here. First, there is a 25% depreciation recapture on the total depreciated value you took a tax credit over the years. Then you pay 15% capital gain tax on your house appreciation if your income as a single is in the rough range $40,000 to $450,000 a year, or more as a couple. The precise numbers are listed on the bottom. You pay 20% if your income is above this range. Then you pay net investment income tax, also called the Medicare surtax, at 3.8% on your gain if you make an income of greater than $200,000 for single and greater than $250,000 for a couple. You also pay Massachusetts state tax, which is 5% in 2020. We are using an example here to give a better idea on what we are dealing with. See, Tim, a guy who has an annual income $220,000 in 2020, is considering selling his four-family rental property. He bought it in 2008 for $250,000. As the market value of it increased to $600,000, he put $30,000 in capital improvement in the last 12 years. And he totally took $120,000 depreciation in the last 12 tax years. Based on these numbers, he has $113,300 total tax liability of this property if he just sells it. Since Tim doesn't need the cash right now, he decided to use 1031 exchange and reinvest the sales proceeds in low-maintenance investment properties. To get a 100% tax deferral, he needs to reinvest all the cash and purchase the next property or properties at equal or greater than the net sale price of the one he's selling. Well, some people choose to do a partial 1031 exchange, where the property they relinquish is worth more than the replacement property, but they will have to pay tax on the difference. To do things right, Tim must follow strict IRS rules. First, he can't touch the money from the sales Otherwise, it may become taxable. So Tim is required to have a neutral third party known as the accommodator or qualified intermediary. The accommodator's job is to hold the funds in their name, not in Tim's name, while Tim does the 1031 exchange. A qualified intermediary ensures the process is completed properly. Tim has 45 days to identify his replacement property or properties, starting on the closing date of his sold property. And he has 180 days to complete the acquisition from the same closing date of his sold property. Again, from the date of sale, Tim has the identification deadline of 45 days and the purchase deadline of 180 days. To identify replacement property in 45 days, Tim had to follow one of these three rules. The top one is the most common, called the three property rule. You identify up to three properties of any value and buy at least one. If Tim identified more than three properties, then Tim goes to 200% rule or the 95% rule. Tim identified more than three properties with the total value not exceeds 200% of the market value of his sold property. Then he follows the 200% rule. Or if Tim identified more than three properties and the total value is more than 200% of his sold property, he needs to buy at least 95% of all the properties he identified. 95% rule. Before we go, I need to remind you that I'm a realtor and a real estate investor. I'm not a licensed accountant. I'm not a licensed attorney either. So you may need to consult your tax or legal advisors for your specific situation. 1031 exchange can be quite complex, so it's a good idea to get professional help. Thank you for watching, and you are welcome to subscribe to my channel. See you next time.